Have you ever felt like you're always one step behind in the markets, missing out on those crucial entry and exit points? What if I told you that there is an indicator that could help you spot potential reversals before they even happen? In this video, I'm going to showcase a powerful tool that combines price and volume to give you an edge in the markets. If you happen to find value in this video, remember to leave a like. Let's get into it. Now, to get started with this strategy, we need to add the VWAP Z-Score indicator to our chart. To do that, you want to go to TradingView, which is the trading platform that I'm going to be using. If you need to sign up, the link for that is going to be in the video description. Next, you want to load any trading security that you like on any time frame. This indicator is pretty versatile and it's going to work across the board. Next, click on the indicator search tab and type in VWAP Z-Score with signals. Make sure to select this one by UAlgo. So what exactly is the VWAP Z-Score indicator? Well, in simple terms, it's a tool that measures how far the current price deviates from the volume weighted average price, or VWAP, in terms of standard deviations. This deviation is known as the Z-Score. By calculating this, the indicator helps us identify overbought and oversold conditions in the market, highlighting potential reversal points. VWAP is a powerful metric used by institutional traders to gauge the average price of a security weighted by volume. By knowing how far the current price of an asset is from the VWAP, you can get a sense of whether the market is overextended in one direction or the other. The Z-Score quantifies this, thus giving you actionable insights. The VWAP Z-Score indicator consists of several key components. First, there is the Z-Score line, which oscillates above and below zero. When the line is above zero, it reflects a positive Z-Score, indicating that the current price is above the VWAP. The higher the Z-Score, the further the price is from the VWAP in terms of standard deviations. Conversely, when the line is below zero, it represents a negative Z-Score, showing that the current price is below the VWAP. The lower the Z-Score, the more the price is below the VWAP. Next, we have the upper and lower thresholds, each of which consists of two levels. We have the upper threshold top and the upper threshold bottom. We also have the lower threshold top and the lower threshold bottom. These thresholds help identify whether the market is overextended. The indicator generates buy and sell signals based on these thresholds. A buy signal occurs when the Z-Score crosses above the lower threshold, suggesting that the price has fallen below or touched this threshold, indicating potential oversold conditions and a possible upward reversal. On the other hand, a sell signal occurs when the Z-Score line crosses or touches the upper threshold, implying that the price may be overbought or could be primed for a downward reversal. Now, let's take a look at the settings of this indicator and see how customizable it can be. The first option is the Z-Score length, which determines the period over which the VWAP Z-Score is calculated. By default, this is set to 14, but you can adjust it according to your trading style or preferences. Next, we have the upper threshold, which defines the Z-Score level considered as overbought. A common value is 2, indicating that the price is 2 standard deviations above the mean. Similarly, lower threshold defines the Z-Score level considered as oversold. Typically, -2 is going to be used, representing 2 standard deviations below the mean. For this video, we're going to set the upper threshold bottom to 2 and the lower threshold bottom to -2. Also, make sure the Show Signals option is enabled so that the buy and sell signals are visually displayed on your chart. Once you've made your changes, click OK. Now, using this indicator to trade is quite simple, I gotta say, and there are two main strategies that you can apply: divergence trading and pullback trading. Let's begin with divergence trading. A divergence occurs when the price action of an asset moves in the opposite direction of an oscillator, like the VWAP Z-Score. For example, for a bullish divergence, you can see right here that the price was coming back down up to the point where the Z-Score line entered the bottom threshold, indicating that the market might be oversold. But looking at the chart, it didn't go up immediately. Instead, it went down for a bit and then consolidated and then broke and closed below this swing low. Looking at this candle, you can see that it's lower than the previous swing low. But looking at the Z-Score oscillator, we can see that corresponding to this candle, it was actually higher than the previous low. So the oscillator was establishing a higher low, while the price action was establishing a lower low. This, ladies and gentlemen, is a bullish divergence. Now, before we take this trade, we need to wait for a bullish continuation signal. My favorite signal to use is usually engulfing candles. So we're gonna be waiting for a bullish engulfing candle to be printed somewhere here, and if that happens, we will be able to take a long position. We wait for a bit, and this is our bullish engulfing candle. We take a long position here, put the stop loss right under the most recent swing low, which is this one. We want to put it far down to give enough room between the swing low and the stop loss, because this is a reversal entry and markets usually move around before eventually going up. The take profit is going to be set at a risk-reward ratio of 1 to 1.5. If we let this trade run, you can see that eventually it was a profitable trade. And of course, to take a short position, you're going to do the opposite of this. Next, we're going to move on to the second method of trading with this indicator, which is trading pullbacks. But before we dive into that, we will need to add a trend indicator to help filter out trades based on trend. Search for the indicator called 7EMA_5MA. This one created by Storewise. Double-click on it so we can change some settings. On the Inputs tab, change EMA1 length to 50, EMA2 length to 100, and then on the Style tab, you want to disable every single moving average option except for the first two options. Set EMA1's color to red and EMA2's color to green. Once you're done, click OK. Now, with these two EMAs, we can now filter trades based on trend. If the price is consistently trading above both EMAs, it indicates a bullish market, and we will only be looking to take long positions. Conversely, if the price is trading below the two EMAs, it signals a bearish market, and we will focus on taking only short positions. Let me show you an example. In this example, the market is clearly bullish. We know this because the two EMAs are aligned with the green EMA below the red EMA, and the price was consistently trading above both the EMAs, confirming a bullish trend. The second condition is to wait for a pullback, which happens when the price retraces towards the EMAs. At the same time, the VWAP Z-Score should enter or touch the bottom threshold, indicating that the market might be slightly oversold within this bullish trend. In this case, we can see the blue upward arrow signaling the pullback. Next, we need to confirm the end of the pullback. But how do we confirm the end of the pullback? Oh, I'm glad you asked. We're going to confirm the end of the pullback by looking for a bullish engulfing candle. We're only going to be waiting for a maximum of 2 green candles for the engulfing candle. If the first green candle is not engulfing, we will check the second one. In this example, the first green candle was an engulfing candle, so we enter a long position here. The stop loss should be placed right under the most recent swing low, giving the trade enough room. The take profit is going to be set at 1.5 times the risk, letting the trade run. And as you can see, this was indeed a profitable trade. A few hours later, we had another long position. The trend remained bullish and we got another pullback, as indicated by the Z-score entering the bottom threshold. This time again, the very first green candle after the pullback was engulfing, so we enter a long position here. The stop loss rules are gonna apply. So the stop loss under the most recent swing low, the take profit should be set at 1.5 times the risk. This trade too was profitable. Now, let's take a look at how to apply the same strategy rules to a bearish trend. Here, the trend is clearly bearish, with the price trading below both EMAs, the red and the green EMA. Now, to confirm a pullback, the Z-score needs to enter or touch the upper threshold, indicating that the market might be slightly overbought in this bearish trend. The blue downward arrow signals this pullback. Now, to confirm the end of this pullback, we wait for a red engulfing candle to be printed. Again, we're going to wait for a maximum of 2 red candles to appear. In this case, the very first red candle was engulfing, so we enter a short position right after this candle. We place the stop loss just above the most recent swing high, which is this one right here. The take profit should be set at 1.5 times the risk. As we let the trade run, we can see that it was also a profitable trade. The VWAP Z-Score with Signals Indicator leverages both price and volume data to provide a more nuanced view of market conditions. When combined with the EMA for trend analysis, you are aligning your trades with the broader momentum of the market, increasing the probability of successful trades. Ladies and gentlemen, that's the VWAP Z-Score with Signals Indicator, a powerful tool that can give you a significant edge in the markets. Go ahead and figure out how you can use it in your trading strategy. And if you find a way to use it, be sure to let us know in the comment section below. That's been it for this video. I really hope you found some value. If you did, hit the like button below and consider subscribing and turning on your notifications so you never miss out on any videos we upload in the future. Goodbye for now.